For Morningstar, I'm Jeremy Glazer. One of the dominant themes in the recent past has been the U.S. economy growing faster than Europe and some concerns about a slowing China. But is that growth starting to balance out? I'm here with Bob Johnson, our Director of Economic Analysis, for his look at the data. Bob, thanks for joining me.
Great to be here today.
So let's start in Europe. They've been very aggressive, at least recently, in terms of quantitative easing programs, in terms of trying to weaken the euro against the dollar. Are there any signs that these policy moves are starting to have an appreciable effect on the European economy?
You know, absolutely. I mean, we've had some individual country, but we got the rolled up industrial production numbers for February, which again are probably just a little bit dated, but they're showing an accelerating trend in industrial production, kind of 1.6% growth, which is better than the couple tenths that they had been growing. So clearly things seem to have turned the corner there a little bit. And then very recently, we just got some of the inflation data. And inflation in Germany looks up, it's up 0.5%. In France, it's up 0.7%. So maybe we've started to lift off of that deflationary spiral that looked like it was about to set in. And so clearly some things have started to work there. And then one other thing in Europe, too, is that the surplus, the trade surplus, has begun to move up again. It was about 7 billion a month, and now it's kind of up over around 20 billion. So clearly it's improved, and it indicates that maybe the falling euro is beginning to have its desired effect and is really beginning to help their economy.
So is Europe out of the woods now? Is this kind of the end of their doldrums? They're going to be able to grow more, or is this more of a temporary boost?
I think they're probably going to have a real boost, but it's not going to last very long. I think that when you've got a currency this cheap, it certainly helps out in a big hurry. But on the other hand, if they don't fix some of their structural things with their labor and tax policy and corruption policies, it's certainly going to still have a tough go of it. So they've got a little bit of a reprieve here, and if they begin to take structural actions, they'll move ahead. And if they don't, this will last a year, year and a half, maybe even 2 years, and then they fade back again.
So some positive signs out of Europe. Now looking at China, we got their growth data. A big worry has been what's the impact of a growing China on the emerging markets, on the rest of the globe. What did we see from them?
Yeah. The number on the headline basis came in at 7% growth for the first quarter. So they're the first one of the major economic blocks that's had a number out here for the first quarter. And that was pretty much in line with expectations, but still one of the lowest numbers we've seen for years out of China. So the expectations were low, and we got a relatively low number. But a little more worrisome is they released a bunch of other economic data on the same day, and certainly some of those numbers were a little bit less good. Retail sales were still a little bit soft, not as much as anticipated. Industrial production was particularly disappointing, kind of in the 5-6% range. So clearly some slowing, especially in the industrial sector there. Again, not a wonderful market. And again, keep in mind that China's currency is tied pretty closely to the U.S. dollar. So as the dollar has gotten stronger, it's also made Chinese products a little bit less competitive. And I think that may be some of what's sinking in the export data and fits all of this picture together that we're seeing.
Do you see any prospects of the Chinese central government being more aggressive in terms of trying to boost the economy, or are they happy with these slower rates?
Well, I think they've already tried to be more aggressive. We saw a few weeks ago where they made it easier to take out a loan for a second home. In other words, if you were kind of transitioning from one home to another, it used to be very difficult to get a mortgage, and you had to have huge amounts down. Well, now they've made it easier to do and made the amount of the down payment smaller. So clearly they're kind of on it, if you will, to try to help the economy out. And certainly with all their encouragement of the stock market, things have probably gotten a little bubblish in some of their stock market activity, and that may encourage people to spend a little bit too. But clearly some worries out of China. I still think the long-term growth rate estimates of 6-7% are way too high, that over the next 5 years will be more like 3 to 5% growth out of China, and that will affect worldwide growth.
Now, looking at the United States, we're seeing better news out of Europe and kind of not so great news out of China. Where's the U.S. fall on this? Does the economy still look strong?
Yeah. I think that we've had 2 or 3 months where, maybe even 4 months, where the data has looked really sloppy. It kind of, you pick a data point, it's been a little bit weaker than one would have hoped. And certainly some of it has been weather-related, and it's kind of odd pieces of weather. It's not one uniform pattern. We had a really warm December, which slowed a lot of winter sales. And so that number didn't look so good. And then we had a February that was almost as bad as it was a year ago in 2015. And so we had a very unusual situation with weather patterns really messing up the numbers. And I always get a little worried about economic data when you've got inflation rates shifting so much that somehow something hasn't been counted just right. So I'm a little worried about the underlying data itself. But we had 3 or 4 pretty rough months, but now the one piece of data that I really wanted to see up, I did. Retail sales were out this week. We were up 0.9%. Even you strip autos out, we were still up 0.5%. So clearly kind of a nice rebound from 3 kind of lackluster months on a sequential basis. And the year-over-year inflation data has been pretty stable at 4.5%, 5% for the last 5 or 6 months. This month-to-month data gets a little silly to look at, especially with those weather trends I pointed out.
And what about industrial production?
Yeah, industrial production, that's where we seem to be eroding a little bit. And we'd kind of talked for a long time about manufacturing, just everything that possible went right in 2014 and 2015. Auto sales haven't been quite as good as they were. We've had the things that are exported or commodity-related not doing so well. So there's been a number of pressures, and plus the oil and gas situation have all kind of weighed on production. We thought it would, and clearly industrial production had been down 3 months in a row. Even the manufacturing component had been down 3 months in a row. Now, at least the manufacturing portion has lifted back up. It was up 1/10, not a lot to write home about, but it did better. But maybe we've at least put a bottom on some of the industrial production numbers. But I think for the full year, we're going to come in at 3% growth in industrial production versus kind of the almost 5% that we had last year. So clearly a slowing there, clearly a reason we've been a little bit negative on the economy. The good news is that it doesn't look like we're totally falling apart in the industrial production sector. We're just kind of a little bit slower growth.
But we should be ready for a weak reading on that first quarter GDP.
Absolutely. I think the U.S. GDP number, so you pick a number. Again, inventories are the big question, but I think we'll be between no growth at all and 1%, which will still be better than the negative 2.2 that we saw a year ago in the first quarter and we came back from. But I do think there is a potential for a negative surprise on that GDP number.
Bob, thanks for your take today.
Thank you.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.